All right. This is going to be my explanation of my setup that I like to call triple reclaims. And we'll start by going over some of the basics of the triple reclaim. And then at the end, I will go over some live examples from today's session. So, first is why do reclaims work? You can see this is kind of a doodle of what a reclaim essentially looks like. Um, in a price action perspective, um, reclaims work, in my opinion, because indices are range bound assets, meaning that most of the time we trade in a range. Granted, the ES has gone up every every year for the last however many years, but every day on an intraday basis, we are usually range bound. When price moves violently in one direction, there's a high probability that price will reclaim that move, meaning take that move back. And this is kind of why buying after a breakout rarely ever works. I think uh, almost every trader on the planet can relate to that, in that you go long after there's been a breakout and then it just instantly pulls back on you. And I think that's because price likes to reclaim, especially in futures. Futures are highly predatory. We all know that. And I like to think that the algorithms feed off the psychology of traders. Um, like if you were buying after a breakout, I think there are algorithms specifically designed to turn you into liquidity if you're buying after a move like that. Especially FOMO. I think that is one of the primary drivers of the market. Is we put in a move, and then you get a bunch of buyers after the move has already been put in. And then guess what? Price reclaims that big move. Um, in the context of delta, similar to price action, whatever volume comes in must come out. You can theorize that this is wash trading, meaning that for every buy order that comes into the market, there must be a sell order. And in a lot of cases, that theory is fractal, meaning on multiple time frames. If let's say 1,000 um, lots of buy delta come in, chances are we're going to get roughly 1,000 lots of sell delta that comes out of the market. And this kind of creates that rangy kind of movement on the delta. Um, delta is also kind of range bound. You'll notice if you watch it long enough that it does respect pivots and things like that, which also factors into reclaims. Um, and when a large volatile print comes into the cumulative delta, there's a high likelihood that orders in the opposite direction will reclaim that move, at least partially. You always see it. We put in a strong buy move, and then a lot of sellers come out, and more often than not, um, more sellers come out, or at least enough to reclaim that move and liquidate all of those late buyers that came in, or sellers. Vice versa, it works both ways. On their own, reclaims don't offer much else than an area of possible retracement, but when price action and delta are combined and agree on the direction of a reclaim, the likelihood increases and a trade idea can be formed. Why use two deltas? It's called a triple reclaim because I am using two different cumulative delta histograms. One of those histograms is time by price, one of them is indices delta, and the other one is stock delta. Um, they're compiled with different instruments. So the indices delta contains all of ES delta. It includes micro ES delta. It includes SPY and some of the other ETFs. And then stock delta is a compilation of over 100 different stocks and their respective deltas. Why not combine them into one histogram? Because they're two different asset classes. And technically speaking, an index isn't an asset by definition, and they trade differently. And if you watch these two cumulative deltas for long enough, you really start to understand that they're each different in their own way. Stocks, I mean, pull up a chart of a stock trading right now and pull up a chart of ES. They trade totally differently. They move totally differently. The order flow is completely different. So it just wouldn't make sense to combine them into one histogram, in my opinion. Um, Add to that the fact that indices are usually instruments meant for hedging and high frequency trading, whereas stocks are the underlying asset of those indices and are usually traded by actual traders. Um, Having them separate allows you to better understand the difference between sentiment. So, like I was saying earlier, ES is extremely predatory, and a lot of the order flow that goes on is just wash trading. It's just algorithms trading with other algorithms. Whereas stocks, while stocks still are heavily algorithmic, you get a lot more natural order flow. There are genuinely traders trading that order flow. Um, Another reason is that they diverge throughout the session and then sync back up at key locations. So, um, if we're at a pivot low or if we're at low of day, high of day, previous high of day, any of those special areas that you may watch, you'll often notice that um, indices delta and stock delta will diverge around those locations, and then if something pivotal happens or there's an inflection point, they'll sync back up and head in the same direction together. It's that kind of fluidity that gives you edge. You don't want to be looking at the if you're trading correlations, which is this is essentially correlations. I'm looking for a correlation between price, indices, and stocks. When you're trading correlations like that, you don't want the instruments to be too rigid. You don't want them to be trading the exact same. It's like it's like if you're trading correlations on ES and micro ES. They move the exact same. You're never going to find discrepancies between the two. If you're truly trading correlations, you want there to be fluidity. You want them to be different in their own respective ways. And where there's edge is when they do sync up and when they really all agree on the same direction. Um, you cannot trade a triple reclaim on its own. The way I see it is the triple reclaim is the setup, and the divergence, which we'll get into in a second, is the signal. Um, so reclaims are just in a price action perspective, they're just a price action anomaly. They just occur. They're just on your chart. You can't really do anything with that. It's like a pivot. Pivots exist on a chart, and whether or not you have a system that exploits pivots, whether or not you have a system that avoids pivots, it's just there. It's just on the chart. It's something that naturally happens in price action, and I've come to find that it's also something that occurs in order flow. You may want to trade into a reclaim, but there's nothing stopping the market from continuing lower slash higher. You need an entry signal, meaning if we put in a huge reclaim to the downside and you go long, you're catching a knife. There's nothing stopping it from continuing on you. From a price action perspective, waiting for the right side of the V offers the most security from catching a knife. So that's something that Lance Brightstein talks about is right side of the V when it comes to mean reversion or capitulation trades. And while that is valid, it's just not something that's repeatable on ES because at what point are you going long into a pullback? Or at what point are you going short into a pullback and it's just going to continue in that direction? It just doesn't really offer high EV, and I know that by experience because I've tried trading these simple price action type of setups for years, and they work for a while, and then they don't work for a while, and at the end you get a negative EV strategy. So um, in futures, it just isn't good enough for intraday scalping. The positive expected value is just not there. The moment you enter on the right side of the V, you may have just chased a move that's already over, which brings us back to psychology. The algorithms love to give people FOMO, and it's the same thing if you buy after a breakout. If you're buying before a breakout or if you're buying at the bottom of a move, you're just liquidity. Somebody's going to take advantage of you, especially if you don't have edge in that entry. To remedy this, you need an entry signal to enter the setup. And that's where we get into divergences. When divergences work, divergences are a moment of discrepancy where price and volume do not agree on a direction. So um, they do happen all the time, but they are outlier. Most of the time, in my experience, price and delta like to trade together. They move down together, they move up together, but for brief moments, they'll diverge like this. You can see on the right side of the screen. And they will trade uh, um, essentially opposite of each other. Um, Sellers may be joining the market, hoping for price to go lower, chasing. But the moment price disagrees with them and starts heading the opposite direction, they will be forced to liquidate their positions and join the buying. This is essentially what a squeeze is. Short squeeze or longs can get squeezed too. This is basically what happened with the GameStop squeeze that everyone traded. Is sellers are piling into an asset with the expectation that it goes lower, and when it doesn't go lower, they have to get out. They have to, and this happened. This is fractal. This happens on the largest time frames like GameStop, but it also happens on the smallest time frames like a 3-second chart, which is the time frame that I trade on. In an ideal scenario, the deltas will begin aligning with price action and will move in harmony to the upside, providing a trade opportunity, meaning price will diverge momentarily, which is the signal. And then after the signal, once you're in the trade, ideally, price and delta will then start to curve to the upside, kind of like this. That is an ideal trading scenario for a long. When divergences don't work, because they don't work all the time, especially if you trade them indiscriminately. When traded on their own, they can be deceiving. They provide good criteria for entering trades, but they do not give good exit signals, which is how we develop risk reward. One could use a trailing stop, which may work on some time frames, but chances are your trailing stop will get hit well before any upside can establish, because indices are ranging assets. So you may notice high divergence and you may go long on it, but by the time you're already entered, chances are the move is over and you may have just bought a pullback, a very brief pullback. And now you have a negative expectancy because the trend is going to continue. Happens all the time. Divergences don't always work. Nothing always works, which is why we need filters and setups and factors of support. In a lot of scenarios, trading a divergence at its face value has a negative expected value. A lot of times, a divergence is simply a brief interruption in a larger trend. And if you trade each one indiscriminately, you're catching a knife, essentially. A filter is needed for trading divergences, and more importantly, an objective target to increase its risk reward and its expected value. And this is where triple reclaims come into effect. So you can see here on the diagram, we've got the triple reclaim on all three with a divergence. So the divergence is the signal, but the reclaim is actually the setup. The reclaim is going to offer that momentum to really capture the trade. But at the same time, if you didn't have the divergence and you just traded into the reclaim, I mean, like, where are you going to enter on this? So they complement each other, at least in my experience. So here are some examples. These are a couple examples over the last couple weeks that I've been trading. And you can see here the top is time by price. The middle is index volume. So ES, micro ES, SPY, etc. And then the bottom is stocks. There's over 100 stocks in here. All of them, I believe, are stocks in the S&P 500. So underlying assets, at the end of the day, all of this volume should be quote unquote the same asset, but it's just offering three different perspectives, three different pictures. So you can see here, all three have a reclaim, which is highlighted by the yellow box. In my opinion, a reclaim should be about 2 to 3 times the height of the average candle. This price action reclaim may not be the best example, but in my trading, I would count these 3 candles as one reclaim, because it's one continuous move down. So if that move right there is your reclaim, then it's more than adequate to be considered a reclaim. But these ones are good. These reclaims here have a lot of height to them. Same with this one. And what we want to pay attention to is the reclaim high on each one of these. And then here's the signal, is the divergence. So you can see here we put a move down, and ES is starting to trade back up slowly. But look down here on the stock delta, stocks are still selling off. So the theory is that all of these sellers here on stocks are about to get liquidated because price is going to curve upwards. And the only thing that really matters at the end of the day is where is the price at. So these new sellers, or I should say these late sellers, in theory, should get squeezed. And if we continue to the next slide, that's exactly what happens. Is the delta starts to curve upwards because all of these sellers have to balance. What comes out must come in, what comes in must come out. So all these sellers came out of the market and now they need to buy. They need to balance that move. Same thing on the indices delta. You can see that buyers came in to balance that big move. And same thing with price. Price started to trend upwards, and so did all 3 of the deltas. Price agreed on this direction. So if we go backwards here, imagine you have a long right here at 47 even. You'd be able to ride that up to roughly 52, 53, which I did. These are actual trades that I took. You just don't see my execution on them. Next example, same thing. We have a reclaim on all 3, and some pretty good height too. We got really good height on this one here, and a good divergence. So ES has started to slowly trend upwards. We're on the right side of the V, but we're using volume as confirmation because stocks are still selling off. The theory, same with indices actually. So still more selling coming into ES, SPY, more selling coming into stocks. And the theory here is that those late sellers are about to get squeezed to the upside. And if we continue to the next slide, that's what happens. So price and volume both agree on a direction, and they start trending upwards into this reclaim. And that's because not a lot of contracts have traded here, and they want to trade back through it. It's a range-bound asset. They want to trade back into that direction. They don't always do it, and that's why if you just traded these reclaims, which I have for years, I've tried to trade these as just price action setups. It does not work. It fails more often than it works because you're buying a knife, and the knife can just keep going. But when you combine it with a divergence like this, with a volume anomaly, where more sellers are coming in than price likes, those sellers are going to get squeezed. And you can see how violent that final move is. It's a huge move. And this was a really good trade for me. I think I got long somewhere around here, somewhere around 38.50. And you can see price wound up around 43s. So nice 5-point move there. Next example. This one's a little sloppier as far as the reclaim, but it still worked, and it still follows all the principles that I've just talked about. You can kind of see with some of the price action context back here that we are ranging. We're in a ranging sort of environment. And this just happens to be a pivot low. So one of the things I'm going to talk about is how this does work really well in a ranging environment, specifically for mean reversion ranges. And this is what happened here. So Get a nice reclaim to the downside on price. We have a nice reclaim here on the index delta. And then this is an old reclaim on stocks, but you can also see down here, there's a fresh reclaim too. We've got, it's pretty hard to see because I'm pretty zoomed in, but there is a nice fresh reclaim there too. It just happens to be diverging. So there's an uptrend, a small uptrend on ES and a downtrend here on stocks. And if we go to the next slide, boom, short squeeze. Those sellers eventually get squeezed to the upside. You don't really see that on the stock delta. Like you wouldn't be able to tell that there was just a short squeeze there. And who am I to say that might not be what's happening? There might not be a short squeeze there. All I know is that there was a volume anomaly where there were more sellers coming out than there were than was reflected in the price. And that ended up leading to a big move. We took almost that entire reclaim back. But the reason I get out here instead of holding for that 41 target is we've already taken one of the reclaims back. This reclaim got hit, which means we no longer have 3 reclaims. And the second we don't have 3 reclaims, I want to at least consider taking the trade off. And if we go back to the other examples, it's the same thing here. Entry, exit. We take one of the reclaims back. These two are still valid. It could keep going higher, but one of the reclaims gets hit and I want out of it. A second example, entry here, exit here. This reclaim gets hit. Once the reclaim gets hit, the trade is essentially over for me. Because by the time one of these reclaims gets hit, we've probably already put in a really powerful move. If not, then I'm going to consider getting out of the trade, even for a loss if I have to. Setup parameters must have reclaims on price and both deltas. I already talked about why I use 2 deltas, so 3 in total. The price, the ES delta, and then the stock delta. They should all have directions in the intended direction. So reclaim above if you're going long, reclaim below if you're going short. The reclaim candles, or just the reclaim, should be 2 to 3 times the height of the average candle. So it should be an outlier move. You don't want to count a slow downtrend as a reclaim. It should be a fast move down. That should be your reclaim. Price must be diverging in intended direction. So a bull divergence is when price is going up, but volume's going down. A bear divergence is when price is going down, but volume's going up. Price should be diverging for at least 10 seconds before entering for my time frame. For any other time frame, I would probably say a rule of thumb is at least 3 candles. So if you're on a 1 minute time frame and you get a big dump downwards and you're trying to long into the divergence, you should wait for at least 3 candles, 3 minutes of confirmation before entering. That's just a rule of thumb that I use. To each their own. Slip range environment preferred, although it still works for pullback continuations and capitulation setups. So preferably trade this while the asset is ranging. That's kind of where it works best. But I've had a lot of success using it for pullback continuation and capitulation. It's just a much lower frequency. Entry parameters. You can use a market order or a stop limit order in high volatility, and I recommend that you do. But in lower volatility, you should try to get the limit order. We call it shimmy back. It's essentially just when if you watch a DOM, a depth of market, price has a way of slipping back. It'll go up and then it'll slip back. It'll go up and then it'll slip back. And using a limit order to catch that slip back is kind of just how you grease a couple more ticks out of the trade. And I recommend that for lower volatility. But if we're in high volatility, each rotation is like 10, 15 points. You should market order or preferably stop limit order into the trade. Entry is invalidated if the divergence is broken or a local pivot is tested. So if I go back to that example, if I'm entering right here at 37, I'm going to want to get out of it at 36 or like 35.50. If it comes back and tests that pivot low, I'm either going to have a stop loss right there or I'm going to flat key out of the trade. Go over the other examples. Same thing here. If I'm long at 38.50, I want to risk 37, and you can see 37 never ends up hitting. Same thing with this one. If I'm long 47, I'm going to want to risk 44, and you can see 44 never ends up hitting. That should just be your general risk guideline, and you can use a stop, or you can just flat key out of it. It depends on your trading style. I try to limit out of trades, but I'm really bad at limiting out of trades, and sometimes it gets me into trouble. Volume should confirm price. If you're long, buyers should be stepping in. If you're short, then sellers should be stepping in. You want price, you want the divergence for the entry signal, but you don't really want to see that divergence continue. You want to see it sync up with price. So ideally, if you're catching along, you want to see buyers slowly start to step in, and you get that nice curve on the delta and the price. It's not a bad thing if price keeps diverging. You can see here on this specific trade, I go long here when there's a divergence to the downside, and price keeps diverging. That's not a bad thing. Where it would be a bad thing is if all three were still continuing lower. That's when you really need to get out. If both deltas are continuing lower, but price is still going up, that's fine. If both deltas are going lower, but price is staying flat, that's usually a bad sign. You should probably get out of the trade. And then be cautious of reclaims on your backside. Reclaims work both ways. So if you were getting into a long, but you just printed a huge reclaim below you, you just got to be super careful of that and cut the trade quick if you start to accept into that reclaim. That goes with every system, every entry you take. You should be worried about reclaim on your backside. And then exits, target reclaim high, as I showed in the examples, or reclaim lows for if you're short. If one reclaim high hits, the trade should be taken off as all three reclaims are no longer present. I already talked about that. Be cautious of failed reclaims as these can turn into support resistance. So if you're targeting a reclaim high and you shoot into it, but you fail and price starts reversing on you, cut the trade because chances are that's a failed reclaim and they are going to continue in the direction you do not want. Take the trade off at a local pivot or a prior value area, high or low, if the first target, the reclaim high, seems out of reach. So don't always hold for the reclaim. Take it off at some other local target if you have one, just to kind of preserve that win rate. And then when to avoid. Avoid if price is trending violently. So trend days, do not fade a trend. It's going to be tempting because a trend is essentially one big reclaim, and you're going to be tempted. You're going to see a lot of divergences that are telling you to fade that reclaim. Just don't, or fade that trend. Just don't fade the trend. You can probe at it, and I'm pretty good at probing at a downtrend. I will take longs in a downtrend if all the other setup parameters are there. But I keep my risk super tight. I am not going to sit in it for a couple minutes and see if it works. I'm going to try, and if it doesn't go in my favor immediately, I'm going to cut it. Shorting an uptrend, not within my system. I do not short an uptrend because uptrends will just continue and continue and continue against you. Whereas at least a downtrend will usually put in bounces. You'll get pretty volatile bounces in a downtrend, which at least lets you break even or give you profit. But an uptrend will just grind. It'll grind and grind and grind forever, and you'll never be able to get out of the trade. Which brings me to the next avoid. If price is grinding slowly, if price is super slow and it's grinding, or barcoding in certain environments, it's gonna be a lot harder to pull this off, because you're just not gonna have the height that you need. You're not gonna have the range that you need. The ATR is gonna be super low. Um, so it does still work in those environments, but it's way harder to pull off because the downside risk is way higher than the upside reward. Stock Delta likes to print outlier candles, especially at open. Stocks are prone to glitches, and sometimes you'll see like a 5 million print come in or something ridiculous like that. Just avoid those. Don't trade them as if they're reclaims because they're not. It was just an outlier order. It could be a legitimate order that some broker accidentally put in, or even like a hedge fund intentionally put in. But it it's not going to respect the laws of reclaim the same, especially on stock delta. It's just it's an anomaly. Scroll past it. Don't even consider it as a reclaim. Um, and that's it. So maybe what we can do is we can pour over some um, trade examples from today, or maybe from the last couple weeks. Um, let's see here. Let's see if I can find any good ones. Go back a few days. These are sim trades that you're looking at here, so that's why there's so many of them. I usually do not take this many trades in a single session. So these seem to be some pretty good ones. Let's watch these. And maybe I will hide my own face while we watch some of these. Let's see here though, because there's a lot of selling coming in. Buyers are defending. I'm gonna try along 69.50. So you can kind of see if I back this one up, you can see the divergence here. We don't have a perfect reclaim on price. So this might not be an A plus setup because there's not much of a reclaim for me to play with on price, but we do have a very good reclaim on the ES delta and the stock delta. So I decide to take long. There's a lot of selling coming in. Buyers are defending. I'm gonna try along 69.50. And I get it right there on that little bit of an anomaly. I think I might have gotten a little lucky at that one. Let's see if I can get another one here. So this is a short example. You can see here we have a bit of a divergence. Price is downtrending ever so slightly, but volume is uptrending, and we've got pretty nice reclaim on all three. So let's see what I do here. Put the short on. I should have my voice. Volume. We do have triple reclaim below. I'll try 69.25 for the short build. Let's just see if we feel like taking back this triple reclaim. I'm going to take this one off for a scalp 5-tick win, just because it's getting a little grindy. And there it is. So I take the trade off a little prematurely. It would have taken back the reclaim had I waited a little bit, but I am a discretionary trader, so sometimes I just feel like I need to take the trade off, and that was not a bad trade by any means. 16-tick winner. Let's watch this one. This actually might be one of the examples I used in the PowerPoint. Let's see. There's another divergence here to the long side. So let's break this down real quick. Not a super clear reclaim, but you can see we do have a little bit of reclaim on all three. If I'm going to critique myself, The ES delta does not have a great reclaim, but I think price has a pretty good reclaim, and so does the stock delta, with a beautiful divergence, I might add. That is a really nice divergence there. Try 67.25. So again, that was kind of an outlier trade because you can see I tried to take the trade off 3 different times, and price just kept blowing past my sell orders, and I ended up getting a way bigger trade than I had expected. Let's see if we have any other examples. This one's decent, but I don't really have great reclaim on the ES. Regardless, though, let's watch it. Bullish divergence with slip advantage. I'm going to try a long 70. So I call it out there that I have slip advantage. So you can see here we are in a really nice range here. I have the range lows, which means I'll have range favor. And this is a very obvious divergence here. We are selling off a lot on stocks. ES isn't really uptrending here, but it's also not downtrending, which tells me there could be a defense here. And if ES defends these lows, then all these sellers on stocks might get squeezed. I need buyers to step in here, though. I'm going to take this off at 71.50 for 6-tick win. So I took it off at about the middle of the range. And you can see here on the stock delta, we are starting to get a little bit of buying. So it's not like I need those buyers to come in. It's not like I need the sellers to get short squeezed. It just helps if they do. And that's what I'm hoping happens when I get into a trade like this. Let's jump ahead a few days. So this was last Thursday. Let's see if I can find some good ones. This is an 8-tick win to the long side.
Right here. There it goes. There it goes. Let's see if they can run it. Fucking would come right back in.
Yeah. I took a shimmy.
I think they. If I would hold that, I would want to try.
Working the exit
all the way to
here.
88.
Got the exit, 2-point profit. So you can hear me and Fat Cat talking over each other there. But to break this one down a little bit, let's go back to the entry. I do have reclaim advantage way back here. It's pretty old reclaim back here on stocks and ES delta. But I have fresh reclaim here on ES. And if I remember correctly, this was also a range day and we're at the bottom of range. Notice how I'm waiting for a lot of confirmation. Like this is a couple minutes worth of confirmation, which to me is a long time as a scalper. If you were buying just the right side of the V, granted it would have worked, but you would have been in this trade for a long time. And what's stopping it from going lower? Nothing. For me, the confirmation is this divergence here. We're defending these lows. Price is not moving lower despite more sellers coming out on stocks, which creates a nice divergence, and that is my signal. Right. I also wait for the shimmy back. So if we watch this here, I'm just gonna mute so I don't hear Fat Cat yelling. I want to go long right around here at 81, but price is already trading at 82s. I'm going to bid and I'm going to wait for the shimmy back because I just know the DOM likes to do that. Price likes to go up and then come down and then go up and then come down. So I bid where I think it's going to shimmy back to. And I end up nailing the trade. And I hold it for quite a while. I get quite a bit out of this one. Yeah, work the exit right there. You can actually see we put in another divergence here while the trade is working for me. And look at that buy volume on indexes. That is helping me. When indexes start buying like that and I'm already long, that is just picture perfect in my opinion. Maybe there are some examples from earlier in the session. This is a pretty good one. I think this might be one of the examples I used in the PowerPoint. Nice little divergence there. I get long on the shimmy back. and it instantly goes in my favor by quite a bit, I might add. Maybe some smaller winners. This one's 7 ticks. So this one's kind of a pullback continuation. I don't have really much reclaim on ES. There's maybe 2 candles there, but again, that's not great. However, I do have a really nice reclaim here on stocks, and I've also got a pretty nice reclaim right here. It's more so of a pullback than it is a true reclaim, but it's good enough for me. And this is my short, so shimmy back fill right there. Back 40.75. And you can see this is when the divergence gets obvious. So maybe I was a little early on this trade as far as a short goes. But it does end up working, and I do have a nice reclaim right there. That's my bad. I thought that was a long trade, but it's still pretty decent for a short. And then maybe let's jump to today, and I'll show you the examples from today's session. These were live trades, and I only had 3 of them, but this was the best trade here, 18 tick winner. Really nice reclaim on price action, decent reclaim on ES, and then a really nice reclaim on stocks. And it just made for a really nice trade. Let's listen to information of the. I'm gonna try it. 70.66 maybe. I'll try the shimmy back 66.50. So pause it real quick. Look how far price has traveled. I'm not filled. This is a limit order. Look how far price is filled, but I'm going to leave this order here because I do think a shimmy back to that price is still possible. For the record, the divergence here is kind of hard to see. This was the original divergence here. Price uptrended while stocks still continued selling, and stocks are still kind of selling down here. I'm leaning into the reclaim more than I am a divergence at this point because it just looks like price is going to start curving upwards, and it is. And I've still got so much reclaim left up here. I've still got so much reclaim left up here. And it just seems unrealistic that stocks have not begun trading into that yet. I think they're going to. I think huge buy volume is going to start coming in on stocks. Never got it. Okay, I'll leave that order there just for now. And there's the fill. So it comes back, fills me by a tick, mind you, 66.50, and then immediately runs in my favor. Fill, flat key there for a nice profit, and I flat key it. And you can see on stocks, buy volume did come in. Buy volume started coming in, and it helped the trade for sure. And then maybe my second one was 8 tick profit, or third one rather. So you can see here, reclaim, reclaim, reclaim. It's not as violent as I would like it to be, but I still think it's worth probing. Pretty decent right side of the V. I'm going to try the 76 long. Work the exit at 78. Nice little scalp.
All right, so there's some.
So again, it's kind of harder to see. You can see this divergence here. Price is trending up, but volume's still trending down. The indicator changed at this point, so it was kind of hard for me to see them on the indicator. It's hard for you to see them on the indicator, but I've been trading these long enough now that I can see it without having to look at the indicator. It just makes it harder to point out in hindsight. And yeah, that's pretty much where we're at. This setup has been paying really well in the last couple of weeks. I'm recording this video for 2 reasons. One is for me, so that I know how to do it better, but it's also so that I can show it to some of my the buddies in my trading pod and stuff like that. So I think that about sums it up. I should have more examples on my live streams and my trade reviews and whatnot. But in the meantime, I think that does the job.